We all know that active investing is a lot of work. So if you find you just don't have the time or energy to fit it in, here are a few things to know about how to invest with minimal effort. Now, one of the best ways to invest with minimal effort is with broadly diversified funds like mutual funds. And the best way to generate a fortune in mutual funds is by the power of compounding interest. Compounding takes place when your earnings themselves generate more earnings over a period of time. This increases the amount of money being reinvested, and therefore there's a much more dramatic effect over a longer period of time. And according to IBD founder Bill O'Neill, author of How to Make Money in Stocks, there's no right or wrong time to start investing in a mutual fund. The longer you have, the better off you'll be. Think long term and focus on building capital that will compound over years to come. And instead of trying to actively trade those mutual funds with that long time horizon, you're actually better off just staying in. In 10 years, from 2005 to 2015, the S&P 500 had an average annual return of 7.3%. But for the typical US shareholder who tried to get in and out of the market when different conditions arose, they only averaged a gain of about 4.2% over that same time period. Many investors often end up selling too low and buying too high, and their timing is off. With this strategy, you're better off just staying in because some of the biggest days in market history happen during the middle of a bear market. So if your timing is off, that could really have an impact on your returns over the long run. And according to O'Neill, in order to thoroughly reap the benefits of mutual funds, you need to avoid the mistakes of being affected by market news, not thinking long term, and worrying too much over a fund's management fees. Other big mistakes include not staying in for at least 10 to 15 years, selling out of fear during bad markets, and losing patience and confidence in the power of compounding. Now, many of us who have 401ks and are making contributions have a big benefit of just staying in for the long run because with those monthly contributions, you will be buying shares in mutual funds at a lower price when the market is bad. And the more you increase your 401k contributions, the more you can reap that benefit of dollar cost averaging over long periods of time. This is not the same approach that we use when we are picking stocks for our actively managed accounts. This is specifically with these longer term accounts with either mutual funds or ETFs, which a lot of people like even more because of the lower fees and the ability to trade them just like stocks. Just make sure you're going with a broadly diversified fund. And as with all good things, it takes time. So keep that patience and remember the market could go down for long periods of time. But if you have a long-term time horizon, just stay the course and you will see powerful results.